Well, hi, welcome to our Mortgage Express with construction loan talking. We're going to wait just a few more minutes.
Right.
Looks like we have a couple of people we're still waiting on, so we'll give it just a minute or two.
Yeah.
Is that okay?
Yeah,
Okay.
I mean, it sounds good to me. I mean, that's fine with me.
Okay.
Oh, busy week right now.
That's a good thing.
Yeah,
We like that.
it is a very busy week. Busy
What-
month and
yeah.
end of the year.
Y'all will have to chime in and let us know how, if it's
Yeah.
the rates, the Federal Reserve dropping the rates made you want to run out and buy a house.
Oh, we've been getting a lot of those. A lot of those.
I know, right? Which is a good thing.
But we're not going to talk about those today because those are always a fun
We could get into
topic.
that.
That's
I know.
not today, though. We're going to do construction today.
Yes, we
Thank
are.
goodness, because I think if I hear one more time about feds and rates, we're just like, let's not worry about that, right?
The wall and like, bam. And like, not enough.
I'm like, sometimes.
Bam.
They're like, why not enough? Why not more? And I'm like, I don't do it.
Here we go. And why didn't the rates drop? They're supposed to drop. The Fed dropped, but we'll get into
always.
all of that on a different thing. I actually
Yeah.
have a podcast that you can look at on YouTube that explains that reason. But anyway.
That one's a fun one.
So, Ashley, are we good? Do you think we should get going now?
Yeah, let's get
Yep.
rolling.
All right.
So, again, introduce ourselves. I'm Dawn Hall. This is,
Mallory Geraci.
I'm her mom.
I'm the daughter, if you haven't figured that one out.
Mother-daughter team. So, yes, so we're your Mortgage Express team, and as we've done in the past, we're going to kind of touch on construction loans, rehab loans, lot loans. They kind of all
Yep.
are intertwined. So we're going to do that and tell you about some new programs that we have that we're super excited about. And with the market the way it's going, it's a good time to build.
Yeah.
And get that house, that dream house that you'd like.
Yep. You want those
So-
pocket doors? Add them right into those. Me.
And real quick, why we like you to choose Mortgage Express is we want to teach you or help. Maybe not even teach is not really even the word.
Yep.
Give you more of information and inform you on what you can do so you can make a decision as to whether you build, whether you buy a house that maybe needs something added to it. You love the house, but it needs an upgrade.
Right.
You can do all those kind of things. And also just give you the information so you can make an informed choice. We're not here to send you in any different direction.
Nope.
We're just here to help you get to the end point. That's what we want to do.
And we also do, if, at the end of the webinar, if you want to have any questions, if there's something more specific, always reach out to us, because sometimes it may not just be cookie cutter questions, and you're like, I got it but I didn't understand it. And if you want just like a little bit more in depth about it, that's what we're about here too.
Yep. So Matt, why don't you tell us a little bit about the agenda and what we're going to talk about today?
So we're going to be talking a lot about the lot loans, like we were saying, and the construction loans. We're going to figure out how to finance on your own lot and a land, and we'll kind of go between what's the difference, because there's actually a difference between land and a lot. I never knew that until I came into this. I thought all of it was land, and then there you go. But it's not. It's not. And then also about how to use your equity of your lot into your builds and into
That's a
your
good thing,
construction
too.
loans.
Right.
And then we're definitely going to go over our construction financing options. We do have one that we like to talk about. It's the one-time close, and Dawn's a little bit more. I'm still waiting to do my class on that one. So she's got a little bit more information on that. And then we'll go into a lot of like the rehab loans that we have for our investors, our partners that we work with. And then we're also going to do what a shell home completion is as well. And there's a difference between like a shell home and the rehab homes, and a lot of confusion of like what it is. And then we also are going to do owner builder options as well, which is one of my favorites that I like to do, because
She's marrying a gentleman that likes to build houses.
he does build houses. So I hear it on my back end at home, and I'm like, oh, yay, keep going. So I'm big on the owner builder ones, because that's also awesome to do.
Okay. Well, let's start with the understanding vacant land. Why don't you go ahead and jump into that, Matt?
Okay, so a vacant land is more than an acre. Bet you didn't know that one. I did not know that one. And a lot is less than an acre. So that's the biggest way that you want to find the difference between it. Land is more than an acre, and a lot is smaller than an acre, but it also is you'll hear it as like a parcel. You can also, if it's broken into different ones, you can, like, say you have like 4
acres,
that are all,
and they're all different.
4 acres and they're all different. You can strap them together and make it one big land.
Right, if you find some next to that.
Yep.
And the thing with acreage, that's kind of how we talk about it. Differences, not just land, we actually call it acreage. There are different things to look at when you're looking at acreage. You want to make sure that you're allowed to build a house on that.
Yes.
A lot of times acreage is considered either commercial or agriculture. And some agriculture land will allow you to build on it, but some will not. And so that's some of the things. I get into
those a little bit where it's like certain parts of it, of the land is agriculture and some of it is residential, that you can do residential or commercial. And that's where it gets into a touchy subject as well. And
those are things we can look at. If you have a piece of property that you want to buy, you can always call us and we can check and find out. We run into that a lot in some North Fort Myers a little bit, LaBelle. We get that in LaBelle, Hendry County, things like that. And we do lend out all the way out there.
We do.
So, that kind of thing. And when you're also thinking of lot loans, as far as lots, I always think in my head things like Fort Myers or Cape Coral. So, Cape Coral will say, oh, it's a 3-lot site. Well, that's 3 individual lots that are all the same size. In Cape Coral, they're all the same size, and then you either have a 2-lot or a 3-lot. Kind of the same thing in Fort Myers. So I guess it's a little more structured.
I would say structured,
And that's a good way of looking at it.
Because that's what I say, like land, I think of agriculture. So you're going to think of like a lot of area, and then the lots.
What kind of loans do we do on those?
Well, those are going to be a little bit interesting loans. So you're going to get up to about 18 months of interest-only payments, which is great. But here's the thing with lot loans and vacant lots and land. They come with most of the time, most lenders are going to do a 3 or 5 arm balloon. So that means you're going to have 3 years or 5 years of small payments and then one large payment at the end. And the reasoning why they do that, and a lot of people have asked me, like, why can't I just make it like a 30-year fixed loan and whatnot? The point of a land and lot loan is to get you to build in our mind. We know it may take you perfect example, my now soon-to-be husband and I are looking into lots because we want to build a home. But we're just not ready right this very second to build the home. But what we want to do is get the lot, hold on to it for a little bit, and then that way we can build onto it later. Because that's what they're trying to do, is they want you to build in the next couple of years. They just don't want you to have just a piece of land and that's all you're going to have. Because what we're looking at is we want you to put a house on top of it.
Because God forbid we have to foreclose or anything like that. We hate to say that, but sometimes if you let the land go, the bank or the mortgage company or whoever's got it, we don't want the land. It's harder to sell than a house. So again, that's why they do that. And with like an 18-month term, that would be a term for if you know what you're going to build
right away.
Right away. But the thing with the 3 to 5s, if you sit on it, the good thing with that is hopefully you can build equity in that land. And if you've owned the land for more than 12 months, we can use the appraised value.
That is
so
true.
If you bought it for 20 and it appraises for 50, you have $30,000 of equity. So that's kind of cool too when you buy. When you're trying to decide, do I want to buy now? Do I want to wait? Do I want to build? That kind of thing.
That's exactly where we are right now, and we're just finding that nice piece of property that we want. Alrighty.
Well, there's draw schedules let's start with that. So one of the reasons it's a good idea to get a lender and get a loan, a lot of people don't want to. They're like, oh, I don't want to pay closing costs. I don't want to pay fees. I don't want to do any of that. But if you drive around Cape Coral, you see a lot of houses that are not finished.
Yes.
A lot of builders went out of business, or people ran out of money. So the object is with going with a lender, you're protected as well as we're protecting you, because on the draw schedules, we give that builder 5 to 6 draws. We do not give them the money unless they do the work. So on each draw, there are certain items that builder has to finish. Now, when we go out, we will send an inspector out to make sure that was done. And then they also do what's called a quick title search, where they make sure that he paid his subs.
Yes.
So that you don't end up having what's called a mechanical lien at the end, where some sub comes and says, hey, he didn't pay me for those floors I put in. You owe me $10,000. And you're like, huh? And the builder got it. And guess what? We can't find the builder anymore because builder isn't in business or something.
They also check for permits as well, which is a big
to
thing,
make sure of all that.
Because that can, if you end up even selling the house, say you build the house, it's all great, it's good to go, you don't have permits on it or something in that nature, ooh, you're in big trouble. Big trouble. They
can't do a CO, you can't move in, and sometimes you have to actually go back, take it out, and put it back in. So it's a mess.
It's a lot. But and going off of like we're here to protect your builder, like not from the builder, we're protecting both of you two, but we're also making sure that you're gonna sign off on what is done. You're gonna get to approve what has been done. It's been done, and when the money, they're like, okay, everything A, B, and C has been checked off. Are we good to go? These are the subs that they picked. Yep, you're good to go. But that money goes to the builder, not to the borrower. I do want to specify that one, because some people think it goes to the borrower and then the borrower distributes it. It does not. It goes to the builder, and then the builder will distribute the money to everybody. So now if you get a sub that's coming back and saying, I didn't get my money, you can go straight to the builder and be like, hey, where'd it go, or where is it?
Correct. And we make sure that, if the title comes up that way, then we say, hey, you got to pay this guy. So, again, they're given most builders know this. Most builders are perfectly fine with doing it this way. And actually, builders don't mind doing it this way because they know they're going to get their money.
Yeah.
A lot of people who have money have given large amounts up front, which you never want to do, and they've run out of money, or the builder can't finish because there is no more money.
Many a times. So, yes, correct.
Well, and we don't want to scare you. It's not a scary thing, but we just want to protect you, and we're giving you the little pieces of it. So one of the newest programs that I am super excited about that we have here at Van Dyke, I'm so excited, is we do what's called a one-time close.
Dun, dun, dun. Sorry.
Because there's a difference between a construction loan and a construction perm loan.
Yes.
A construction loan is basically the construction time, the 12 months, 18 months, however long it takes to build. When you get to the end of that, then you have to get a new loan, what we call a permanent loan.
Permanent loan, yep.
We also have other construction perm loans where they're arms. So if it's a 3-1 arm, then for the first 12 months, that's the first year of your arm. Then after that, for 2 years, it's fixed for 2 years. And then after that, it's a 1-year adjustable. But that's a permanent loan, a construction perm loan as well. This one-time close loan that I'm talking to you about will cover conventional, FHA, VA, and USDA. Dun, dun, dun.
Yeah.
Because nobody does the FHA, VA, USDA. So we are ecstatic about that.
Right.
They basically have the same qualifications as regular FHA loans. You can do 96.5% loan to value, USDA, VA, 100% loan to value. The only caveat to the one-time close with FHA, VA, USDA will not allow you to put a pool in at the build. Unfortunately.
Don't worry about it. Move in. All you need to do, live in the house for a little bit, then we can get the pool. We want to get everything moved in first. Let's get everything moved in, and then let's get you a pool, okay?
And then conventional is the same way. And basically, you'll have a rate during the construction. Then when you get to be about 30, 60 days out of what we call CO and the home being done, Certificate of Occupancy, CO, we would lock your loan. And if for something happens within the next 30, 60 days, you usually get a one-time float down. So you're going to have interest-only payments during construction on a regular conventional loan. Wait till I tell you the FHA, but anyway, on the conventional loan, so you're going to pay interest only during construction based on a one-time rate like 8.5 or whatever. But then when you get to the end, you're going to lock it in for that 30 years and just do the updates to that. FHA and VA allow you to finance that in. So you could theoretically build this house, not make a single payment through the whole thing, so you could live wherever you're living now and not make a payment through the whole construction period, and then start your payments at the end of the construction. So that is fabulous.
Yes, it is.
USDA will get it all at the end. They make you increase the loan at that point, but FHA, VA, they do it right at the beginning. So it opens a whole new area for people to do loans, because nobody was doing some FHA, VA, so we're pretty excited. I'm very excited, in case you can't tell. Very excited.
Very, very excited.
So that's our one-time close. Again, if you have questions, there's a lot more information that we can go into, but definitely call us so that we can go over more if you have more questions. I'm going to kind of move into the rehab loan part. Rehab loans and construction loans are two different animals. Think of it this way. A construction loan is from an empty ground up. A rehab loan is from an existing home.
Adding on.
And you're either going to add on or fix something or anything like that. So usually with the rehab loans, the most popular rehab loans are for adding on or doing that, but a lot of investors do them. And we call them it's fix and flip. Yeah, that's what we call it.
Fix and flip.
So basically you go in, and the good thing with an investor is it's kind of like, if you've seen any of our past reels, it's like DSCR loans, debt service coverage ratio.
Yay! I got her to do it. Yay!
Thank you. So anyway, basically they're going to go off the value of what you're going to get from that house when it's done and all of that. So, but you are required to fix that house in the 6 to 12 month period, and then get rid of it at the end. There is no, I want to keep it, none of that. No, you don't do that. Now, if you wanted to do that, we can do a different investor loan, but we're probably going to qualify you and do all kinds of information that way. Another really popular loan is actually an FHA loan. It's called a 203K, and it is for primary borrowers who are looking to buy a fixer-upper house, but they need to include all of the repairs or anything that needs to be fixed. The caveat with a 203K loan is you do have to have an engineering inspection. Now, if you go into a house and you want a new kitchen and a new bathroom, and on this one, you can repair a pool. So say you want to buy a house that's got a crack in the pool, needs a new kitchen, a new bathroom. And you're like, woohoo! So you give us that information, and we give that to the engineer, but the engineering come back and says, oh, it needs new pipes, and it needs this foundation part fixed.
Structure. Think of structure.
Right. It has to be fixed, whether you want it or not. So that could increase the cost for your fixing it. It may not be a way you want to go, or it might. And the thing with a 203K loan, you can legitimately knock down the whole house as long as you have a square about this big of the slab left, and then you can build around the whole thing. So years ago we did a lot of these in downtown Fort Myers. So it was a major rehabilitation project. So that's a good way, though, to buy a house if you want to do a fixer-upper. So when you're thinking of new construction, rehabs, think of fixer-uppers, adding on, construction, ground, build up. That's what we do.
I like to do the 203K loan as like that young couple that found a house and they want to just do like the structural, like new cabinets, Just a little like cosmetic stuff that you're
That
like,
is
wow,
true.
that's very dated. But if we just change this would be fine. This would be great. But I'm a new home buyer. I don't know what to do. I would like to do it now. I would like to fix it.
And that's a good
perfect for those.
The 203K has a streamlined one, so you don't necessarily need the engineering cert, but you only can do, I think it's like $35,000 up to $35,000 in repairs.
And you think of cosmetic things to make it look pretty instead of structure.
Correct. If you wanted to do the regular 203K and needed a whole bunch of work done, that can be basically up to the FHA loan limit. So that's what you would do with that. So anyway. Tell us about what's going on.
Shell homes, like we were talking about earlier, a lot of, especially in Cape Coral, that you can see, there are homes that are built almost there and something's wrong. You drive by them all the time and they have all the grass that's grown. Nothing looks like it's been touched. Nothing. Those are what are called shell homes. And those could be everything's done on the inside, on the outside, nothing on the inside. Or they could be a slab and 4 walls, no roof.
Or a slab.
Anything on that. It's not but that's the difference between a shell home and a rehab loan.
Correct.
A shell home is where, again, you drive by them and you probably found out that the builder ran out of money or
went out of business.
Or we just closed a loan last month on a shell home where it was actually owner builder. They were building their own home and they used enough money and then they got to a stopping point and went, okay, we're using too much of our money. Now I need more financing. They don't want to get it out of pocket. So they did owner builder. We showed them, they had a slab and I believe they have a little bit of 4 walls. I don't know, I can't remember if they did or not, but it's great because all they did was they added how much they were going to need and they took the appraisal and they took the plans and specs, and that's how they do the appraisal on that. They look at their plans and specs, and then they they did a loan for them.
Yeah.
So, and I was like, wow. So you can purchase a home that's not even finished if it's up for sale and they're just trying to get rid of it. They're like, okay, this isn't going to sell, and you can finish it if you want to. Doesn't have to be owner builder. It could be a builder that says, okay, we'll go in and finish it and everything else. But I don't think I've ever seen that in.
Well, they haven't, because if being around a while, the main reason is usually there's what's called an NOC, a notice of commencement, that's already been filed, which means that is on your title first. Whenever a loan comes in behind, it would have to take second position. Most lenders will not take second position.
I'd say 99.9.
We are the 0.01 that we do have an outlet that we can do that with our broker partner. And to further go into that, just to touch on a little key things that that I think are important, are your builder usually needs to be approved. We have outlets that we can get your builder approved. We also have outlets that we don't need to. They don't care, which is one of the places here. We also do owner builder, and what you will find, there are very few lenders. They used to do owner builders, but a lot of them pulled back when they got oversaturated out in the market or whatever. Owner builder is very risky because, again, it's an owner builder and you're giving the money to the owner to build this house. Whenever you're thinking of why is the lender asking for that, you have to think in your head, what is our layering of risk? What is our risk in that as a lender? And then that's why we ask for different things. So here at Van Dyke, we can do builders, approved or not approved. We can do owner builders.
Love it.
We can do shell homes, which most people don't do. We can do FHA, VA, USDA, conventional one-time closes.
Tongue twister right there.
I know,
Holy
right?
Cow. Okay.
We do lot loans, land loans, and also we use the equity in your land already. And the way we figure out how much money to loan you is we take the value of the land or your purchase price on the land, add it to the cost of the home, and we get total build price. We add them together, they appraise it as if the house is already built, and then that's what we loan on.
Yeah.
So that gives you a little bit of information. I know it's a lot to think about.
Yeah.
We could probably go into another 45 minutes to an hour, if not longer, but we don't want to blow your head. So
And everything gets tailored to
your situation.
What your situation
as
is,
we do
correct.
every loan that we do. Is
Yes,
we tailor
yes,
it to
it
you.
does.
So Ashley, I think you've got a couple questions you were kind of signaling us. So
You
go
can put
ahead.
your hand down now, Ashley.
Thank you. I'm getting tired. Okay, so we do have a couple questions here. The first one is from Sam. What happens if my construction costs go over my budget?
Oh,
Ooh.
well,
I was gonna say, if you're owner builder, I mean that's you. Sorry,
it's you regardless.
That's you regardless.
Here's the thing. So when we do your loan, we have your contract and your lot. We add it together, appraise it that way. If you decide to go in and do major upgrades, you are responsible for those upgrades. So, and in addition, if your builder is telling you he's going over cost, you want to make sure that that builder is really doing the right cost. Because there are some builders that will try to undercut other builders to get your business, but then they come in at the end and charge you. So you want to do your due diligence when you're looking for a builder. We have a lot of builders that we have worked with in the past, so we can give you names of builders that we think are reputable and all of that.
Also, send us the contract. Let us look at it and make sure that there are no clauses or anything in there that...
And that you have it built in.
Yes.
Because you get allowances for things, and if somebody gives you a $2,000 flooring allowance for a 4,000 square foot house, that's not going to work. We want to make sure that your allowances are enough, not too much, but enough. But again, if you go in and decide that instead of this tile, you want this wood, and this wood is $3 a square foot more than what your allotment is, that would be you at the end. So just make sure if you're doing that, you got the money at the end.
Contact us first, and then we'll just let that.
It's always a good thing.
That's always a good.
Okay, let's see. There's a little confusion on what owner builder actually means. Can you tell me what is an owner builder?
So owner builder is I'll just bring it to my husband. He is a general contractor. So he is licensed to build homes. He would be a owner builder on that.
So if you want to build your own house, you want to buy it, you want to build it, you have to have a contractor license, or someone
who
is going to be working
family
with
member.
you that will sign and say,
Yes.
I take responsibility to make sure this
Yes.
house gets done
Correct.
and gets done correctly.
That's what you just think about it. Just make sure that somebody in your circle has a license that will do it. But also if the subs that are going to do it, they need to have the license underneath the general contractor. You need a general contractor. That's all we need.
Thank you.
Mhm.
Okay, this one is from Matt. How do you do an appraisal on a home that hasn't been built yet?
Well, we kind of touched on that. We would take, if you're buying a lot and you're building a house all at the same time, we're going to take the purchase price of the land, the purchase price of the build, add it together, and the appraiser is going to get all the plans and specs, and they're going to appraise that lot as if the home and structure is already there. Now, as we had talked about, if you bought a piece of land over 12 months ago and you bought it for 20,000, but now the builder or the appraiser comes back and says that land's worth 50,000, and he's going to take that land plus the house, add it together, give us an appraised value, which allows us to loan you more. And then that's where you get the equity, because then you can include closing costs and things like that to roll them in, so you don't have to pay as much money out of pocket.
That's my suggestion.
I know we're at 1:30, but we have one more really good question. What credit score do I need, says Holly? for a construction loan?
So for conventional, think of a more, think of a 640. And I believe there was one that went down to 620. Don't quote, as I say, don't quote me on that.
FHA and VA will go down to 620.
Yes.
And again, let's preface this. I know on a regular FHA conventional or FHA or VA loan, you can go lower. You can go down to the 500s
Yes.
or lower, but on a construction loan, FHA, VA must have a 620 score, USDA must have a 640, and conventional must have a 640 or
Yes.
higher.
Yes, and to think about it is, again, with the risk layering, that's why construction loans are a little bit more riskier than an average more like 30-year mortgage, and getting more. That's why they do have the stipulations on it, and
Yeah.
they do it that way. But
So, well, we want to thank you for watching us. I think we have our contact information up
Yep.
here as usual, Ashley.
it'll change next month. I'm so excited.
Oh Lord, here we go. Anyway,
Last name.
oh, that's right. Well, we don't really have the same last name now, but anyway. Yeah, so our information is up here. Definitely give us a call.
Yes.
I'm Dawn Hall. This is
Mallory
Mallory
Gracie
Gracie.
for a few more days.
And my phone number is 239-789-7561. And I'm your lender for life.
And I'm here to support. Just kidding.
Thanks much. We'll talk next month.